Thanks for joining us here on a Monday. I'm Marlin Bohling with you as we watch our ag commodity trade now that it is up and running for the week. And keep in mind, we have a big USDA report coming up tomorrow. Here to talk about today's trade, we have Chris Swift in the studio. Of course, he's with Swift Trading Incorporated in Nashville. How are you?
Doing great, Marlin. How are you this morning?
I'm doing fine.
Good.
Happy Monday.
Thanks, sir. Same to you.
So the trade seems to be a little bit reserved, let's say, ahead of the USDA report tomorrow. What do you make of this?
Well, I think it's all due to the tariffs and the tariff talk that we've got with the United States and Canada and Mexico and China and all of the others. And we noted a couple of weeks ago when Trump finally came back out again and said, don't forget about those tariffs. The market's been going down ever since and hasn't stopped. So,
but how much of this is weather, though, do you think? I mean, it has to be a factor, I would think.
I think some of it is good. I think the crop itself is in fairly good shape from what the USDA reports on its weekly crop progress report, but the demand is still phenomenal. That's what I keep looking at every single week is China bought tons and tons of beans from South America last week that could have been U.S. beans. So I think that the demand is good. I think it's going to remain good. We just have to get this little dark cloud of tariffs off of it, and I think the market will respond appreciatively to it.
I guess the key factor there is it is draining it off of the world supplies, though.
Yes.
No matter where they buy it, I mean, somewhere the whole supply is shrinking.
The demand is phenomenal out there. You got the largest numbers of pork, poultry, and beef on feed right now worldwide that you've ever had, and you just can't let those animals starve. You're just not going to do it. So it's going to take some real men to get up there and come to some agreements with this, but I believe they will.
Okay, let's look at prices here, and let's go to the big board. Okay, first up, on the corn, down 5 3/4 on July at $3.72 per bushel. We have December down 5 1/4 at $3.92 3/4 per bushel. On the soybean trade, here we have July down 10 1/2 now at $9.58 3/4. November down 11 at $9.78 3/4. On the wheat market in Chicago, we have July currently trading at $5.15 1/4. Now it is down 4 3/4, and December down a nickel. Kansas City, we have July there trading at $5.35. That is down 3 1/4 cents on the day. And on the Minneapolis spring wheat trade, you now have your July contract down a penny and a quarter at $5.91 1/4. What about cotton? We opened up cotton a little higher on the nearbys. Right now we're mixed. We have July down 7 points at 94.87. It's showing a little bit higher trade in October, but there's very little volume usually in October. December down 55 points right now, and it is at 92.05. On the wheat, you going to be patient and wait this out, or would you sell right here?
I'm not a seller of wheat right
You're
here.
not.
I think that we have really bad troubles, and as harvest really gets underway, we're going to see less and less yield per acre come out there. So no, I'm still very adamant that the grains will move higher. And again, this dark cloud, we got to get it over with.
So somebody's looking at it as an opportunity.
Yes, absolutely.
Always. All right. Okay, we'll come back in just a moment. I want to pick your brain here on the livestock.
Okay, yeah, that was a good one on Friday.
We'll be talking more with Chris Swift in just a minute about our livestock trade. Let's go back to our conversation here with Chris Swift of Swift Trading Incorporated in Nashville, and he's on set right now. All right, Chris, I want to take a look here at our livestock trade, and we'll go ahead and pull up our live cattle quotes here for everybody. We'll get them updated on the current trade. So let's go to the big board, and here we are. Still not moving much. Very quiet. A little weaker bias here. We have June live cattle trading 7 cents lower at 109.95. That's the one that's in delivery, right?
Correct.
Okay, so August is down 26. Now down 28 at 105.50 per hundredweight, and October down 40 at 107.80. On the feeder cattle trade, let's switch over there. We have August now down 43 at 146.85. So that is now about $1.20 off of its earlier high from this morning. And now we have September trading 45 lower at 147.97. October down 35 at 148. So talk to us about this cattle futures trade here. A weaker bias right now, but we had a cash cattle trade that finally, and I mean finally, developed late on Friday after everybody pretty much went home for the weekend.
It did.
And it was $5 higher. So what gives? Why are we lower in futures?
Well, I think still we're looking at our best demand time frame right now. Now through the 4th of July, we will kill more cattle for more consumer consumption in the next 3 to 4 4 weeks. After that, it'll slow down some, and we're still going to have the elevated inventory, not only of beef, but of pork and poultry both. So I believe that what we're doing right now is seeing that astute demand right here in front of us. And not that I think that the demand won't continue to be, but what we'll probably end up seeing is some of the summer doldrums. We've still got a lot of cattle to have to kill, and once they back it up just a little bit, then it really begins difficult to try to get ahead of the game again. And right now, they're very, very much ahead of the game.
You were commenting as we were in the break a little bit ago about the high number of heifers that had gone to market.
Yes.
And what does that mean for long-term implications here?
Fewer breeding stock. So they have transferred the going into the kill cycle back into the, going from the breed cycle back into the kill cycle. So we've noticed this for months and months that the elevated heifer kill has been coming. So I think it just tells you that we are done with expansion. We're in no way near in liquidation, but probably some pretty heavy contraction right now. Prices have not been going up. The price of money has been going up. So it makes it more and more difficult for anybody to want to expand, hold back heifers, want to buy a new bull, anything along those lines. They're just slowing down.
How much of that is related to the drought in pasture land?
I think some of it is, but this has been going on for quite a while. So I mean, when we look at the heifer kill, clearly they were placed 150 to 200 days ago, and that has been elevated for the last 6 or 7 months. So that's been going on for quite a while. I haven't really heard of any kind of liquidation due to the drought out there, but I do know it's serious. It's very serious.
Let's look at the lean hog trade right now. And on the big board in Chicago, here we go. We have June futures 22 higher at 80.10 per hundredweight. July now 53 higher at 81.25 per hundredweight. August up 20 cents at 77.32. The far out deferreds just can't keep up, and they're already at a discount. Why is that, Chris?
I think a lot of pork production. We saw in the last quarterly hogs and pigs report that we're just going to produce more and more hogs, and summertime tends to be a really good belly month, and bellies hold a premium, so the hog carcass holds a little bit more premium. But after that, you can see the prices begin to slip once you get into August, and they stay that way.
All right, Chris, thanks so much.
Absolutely, Marlin, pleasure.
Always look forward to having you come in.
Thanks.
Chris Swift of Swift Trading Incorporated.